Ever wonder how the stock market works and how people make money from it? If you're feeling a little lost or intimidated, you're not alone. The good news is, you don't need to be an expert to start. What if I told you there are just a few simple basics that could totally change the way you think about investing? In today's video, I'm going to walk you through the top 5 things every beginner should know before jumping into the stock market. These tips will help you avoid common mistakes and make smarter, more confident choices with your money. Let's get started. 1. Don't be afraid of ETFs, exchange-traded funds. If you're new to investing, one of the best entry points into the stock market is through ETFs, short for exchange-traded funds. An ETF allows you to invest in a basket of stocks with just one purchase. Think of it as buying a mix of stocks that represent an entire sector, industry, or market index, like the S&P 500. ETFs are great for beginners because they offer diversification right off the bat. Instead of putting all your money into one stock, an ETF spreads your investment across multiple companies. For example, if you invest in an ETF that tracks renewable energy, your money will be spread across companies that focus on solar, wind, and other green energy sources. This diversifies your risk and can provide more consistent growth over time. ETFs can also be low-cost compared to other investment options, and many of them even pay dividends, which means you can earn money just by holding them. While they might not give you the huge gains that individual stocks might offer, they can be a safer option for beginners. By choosing ETFs that track strong, broad indexes or sectors, you're putting your money into a strategy that's more stable and less prone to wild fluctuations. Moreover, investing in ETFs allows you to avoid the complexity of picking individual stocks, which can be daunting for newcomers. With ETFs, you can get exposure to multiple sectors and industries with just one trade, making them a smart and simple choice for those who want to start building wealth without too much risk. 2. Don't be afraid of individual stocks, either. While ETFs are great for beginners, don't let them make you shy away from investing in individual stocks. In fact, some of the most successful investors in history, like Warren Buffett, built their wealth by carefully selecting individual stocks that they believed would grow over time. Individual stocks, like Apple, AAPL, or Nvidia, NVDA, can provide higher potential returns, especially if you choose the right companies. These stocks can give you the chance to benefit from the success of well-established businesses, and over time, you could see significant growth in your investment. For example, early investors in Apple and Nvidia have seen their wealth explode over the past decade as both companies grew rapidly in value. However, there are risks. Not all stocks perform well, and some companies may not live up to expectations. That's why it's important to do your research before investing in individual stocks. Look at their financials, growth potential, and industry trends. Understanding what makes a company strong and whether it aligns with your long-term goals is critical to avoiding costly mistakes. Furthermore, when you invest in individual stocks, you're putting your money into companies that could be at the forefront of innovation or changing the world. With the right research, these companies can reward you with massive returns. But be sure to invest wisely. A diversified portfolio of individual stocks and ETFs is the ideal approach for long-term financial success. 3. Check the stock's history. When investing in individual stocks, past performance isn't everything, but it's still a good place to start. By reviewing a company's stock chart, you can get a sense of how the stock has reacted to market conditions in the past. For instance, many travel and airline stocks were hit hard in 2020 during the pandemic, but they rebounded as demand returned. This gives you context about how resilient a company is in tough times. Looking at the 5-year or 10-year charts can help you understand how a stock behaves during periods of growth and downturns. Does it recover quickly after a market dip? Does it consistently trend upward over time? These are important questions to ask when you're deciding if a stock is worth investing in for the long term. But remember, past performance does not guarantee future success. Just because a stock has performed well in the past doesn't mean it will continue to grow in the future. It's important to combine your research into the company's history with other factors like its financial health, management team, and industry position. In short, Checking the stock's history provides you with valuable context, but it's just one piece of the puzzle. It's essential to also consider future potential, not just past success. If you're aiming for long-term gains, it's important to align the company's historical performance with future growth projections. 4. Read the financials. For many beginners, diving into a company's financial reports can seem like a daunting task. The numbers, the terminology, it can be overwhelming. But the truth is, you don't need to be an accountant to understand these reports. In fact, financial reports are one of the best ways to get clear, actionable insights into whether a company is growing, generating profits, or possibly struggling with debt. They provide a snapshot of the company's overall health and performance. To start, focus on some basic financial metrics like earnings per share, EPS, cash flow, and debt levels. These key figures can tell you if a company is making money, how efficiently it's managing its cash, and whether it has too much debt. Most online brokerage platforms, like Fidelity or Charles Schwab, offer easy-to-read summaries of these metrics, making it simpler to understand the health of the business you're investing in. By reviewing a company's debt levels compared to its earnings, you can get a good idea of how much risk is involved. A company with too much debt may be more vulnerable to market changes or economic downturns, which could negatively impact the stock price. Additionally, financial reports show whether the company is investing in growth or merely trying to maintain its position. For example, are they using their profits to fund new innovations, expand into new markets, or strengthen their core products? These are critical signs of a forward-thinking company. Even if you're not a finance expert, taking time to read and understand the big picture will help you make more informed investment decisions and build your confidence in the stock market. With experience, you'll find yourself making smarter, well-researched choices. 5. Remember, the market doesn't care about you. This is one of the hardest lessons for new investors to accept, but it's an important one. The stock market doesn't care about your feelings, your enthusiasm, or your gut instincts. The market reacts to business fundamentals, growth, and investor sentiment at scale, not individual hopes or fears. Take, for example, a stock that's trending on social media. Just because a stock is getting a lot of attention online doesn't mean it's a good investment. Often, hot tips and trending stocks are driven by FOMO, fear of missing out, not solid financial analysis. Emotional investing can lead to buying into a stock that's overvalued or jumping into a trend that's already past its peak. To avoid this, focus on logical, well-researched investments. Stick to your strategy and focus on stocks that align with your financial goals, rather than those that are getting attention for the wrong reasons. By avoiding the hype and doing your own research, you will be better prepared for long-term success in the market. While the market might seem indifferent to individual investors, by making data-driven decisions and focusing on the fundamentals, you can make the market work for you. So, trust your strategy and don't get swayed by the crowd or short-term trends. The market's true value comes from your long-term commitment to investing wisely and staying informed. So there you have it, the top 5 stock market mistakes that can sabotage your stock market success. From emotional decision-making and trying to time the market to ignoring diversification, these are the key areas where investors tend to go wrong. But now that you know what to avoid, you can take control of your financial future and make smarter decisions that will help you build long-term wealth. The stock market can be an amazing tool for growing your money, but only if you approach it with the right mindset and strategy. Avoiding these mistakes and staying disciplined with your investment approach will help you get closer to your financial goals. If you found these tips helpful, make sure to like, share, and subscribe for more insights on investing and building wealth. Thanks for watching, and I'll see you in the next video.